Hello, and welcome again to this installment of our Industry Leadership Series. I'm Brian Dobson, Head of SPAC and Disruptive Technology Equity Research at Chardan Capital Markets. Today, we are very excited to be hosting Alpaca Finance, and I'll start by reading some important disclosures. During this call, we will not be discussing Chardan research. Any discussions about research should be coordinated between a participant and their respective salesperson. Our compliance team has asked me to read this statement for the investor call. By participating in this call, our speakers attest that they have made Chardan aware of any potential conflicts and will not discuss any material non-confidential information that they are aware of that may breach their legal, regulatory, or fiduciary responsibility to any parties. So thanks for bearing with me through that. Alpaca Finance is a dynamic business that operates in an important DeFi market segment. Its crypto lending platform provides high generating opportunities to DeFi participants seeking either passive income or active clients seeking higher yields via yield farming. And today we're joined by Pete Woodard, Head of Institutional Growth. Pete, thank you so much for joining us today.
Pleasure, Brian. Thanks for having me.
Yeah, wonderful. So let's kick it right off with some big picture theme questions. One thing we like to start with is asking you about the mega trends and external factors that are shaping your industry's path and your outlook for the next 2 years. Do you think you could maybe touch on the broad strokes for some of our investors?
Yeah, of course. I think, we'll touch on it probably a bit later, but I think regulatory is particularly a mega trend for crypto and DeFi. Like anyone following the space, we had sort of like a Lehman moment the last couple of weeks, whereby about $40 billion were erased off the market via a algo stable coin that went south. So I think that may sort of usher in further regulation, particularly on what stable coins look like in the future. But like regulation across our industry changes from country to country. Whereby I think in the States a lot of the actors are wanting to understand regulation first before they wholly participate, and that's from a B2C and a B2B kind of fund institutional perspective. And as you kind of go east, it changes very in different ways. Particularly in Europe has MiCA coming in, and Singapore MAS has more regs coming in. So I think that's one trend to see how that will shape what DeFi is in the future. But generally, again, from that kind of Lehman moment, generally, I think if anyone uses crypto DeFi, we have different chains that people will utilize. I think there's going to be more consolidation into the chains that have shown security and sort of distribution scalability over the coming years in particular. In our industry, typically there's lots of movements and migration of capital depending on where the best risk return ratios are, but I think those can potentially kind of consolidate. And I think as we go, we've seen with crypto DeFi, there's been, we have exchanges, we have money markets, and we have other things that have built on top of that with under the term sort of money Legos. But now we're seeing more, products come on chain where you have, options and derivatives in particular that are starting to kind of heat up. And at least for the people in our industry, may look to kind of facilitate those, particularly sort of perpetuals. Those are potentially coming on more on-chain when compared to CeFi or centralized crypto that we've seen before. So I think our industry likes to push the boundaries a fair amount and see how much of traditional finance we can bring, as they say, on-chain, and in our view, kind of make it a more transparent operating environment with different bells and whistles than you'd find maybe on Wall Street.
Yeah, thank you for that overview. I guess let's expand on that a little bit. How is your team positioned Alpaca to grow within that environment?
Yeah, for sure. So we focus quite heavily and we can get into kind of like how our product works probably later on, and sort of, from our position, we have a very strong revenue model, and that this may seem insane for some people, but a lot of actors in DeFi don't particularly have a revenue model in place. They provide sort of a service, and we'll kind of figure it out after. So, we've been lucky enough to sort of take a very well cash flowing company and then reinvest in towards our future. So that looks in a couple different ways, and typically it follows trends and where we see those trends going. So, one, we're just basically investing into our core infrastructure. So going from what is a version 1, which we've utilized over the past year or so, or was over a year, hosting anywhere from about 600 to about 1.4 billion of essentially AUM, but we call it TVL, so total value locked within our protocol, and sort of reinvesting it and kind of growing and scaling that to offer many different things and options. The other thing that we're doing as well is we see that many more institutions are entering in DeFi and getting a lot more comfortable. And like, institutions are, again, broad stroke in the sense that, we see sort of like DeFi focused funds that entered first. Next were, market makers that did like a DeFi carve out because they're around the industry. So crypto market makers, and that's kind of going up the ladder from there. So we are rolling out in the coming months a structured product, so a 3 tranche structured product that is focused on the Ethereum blockchain that will provide fixed return and downside protection for senior and mezz, and then junior will be floating. But I think that's very much positioning us for the future, in the sense that Hover will capture a lot of the user base that is maybe a bit more risk off, but still want sort of exposure to DeFi and a form of, let's say, insurance in the downside protection coming from that product, which, in our sector, there is some insurance providers, albeit capacity is quite limited. And outside that, you're sort of, the risk is up to you to fundamentally quantify.
Right. And speaking about risk and the broader mega trends, I guess, how would you describe the competitive landscape for your company right now, and what are the near-term obstacles that you see developing that you'll have to overcome? Certainly, the market's been very volatile as of late.
Yeah, it's a volatile market that's effectively correlated with traditional markets, at least up to date. There hasn't been a decoupling quite yet, although I think we're all waiting for that to happen. And on the, looking at some of the traditional sort of even like tech stocks, it's starting to look not as volatile as some may kind of think it. But generally, in DeFi, there are multiple chains that provide an infrastructure to build decentralized finance on top of. Akin to traditional markets, typically sort of first movers kind of dominate the core building blocks of that chain, whether it be decentralized exchanges or money markets. In our case, we effectively are an under collateralized lending protocol, in the sense that users will put up collateral, borrow that to lever up these yield farming positions. And it's not particularly easy to do, I would say, when compared to a DEX or a money market, it's not as easy to do. And we were lucky to kind of be first movers on the chain that we're on, which is BNB. And we've retained the top 3 TVL, so AUM, on that chain, and sort of very much sort of a hallmark across all of DeFi, being around top 30. So there has been people who have attempted to replicate what we do, and in our industry, the technical moat around us tends to be less because it is open source. So people may have heard the term forking, so people can effectively copy the code, but you really need to know how to work that code. So we've been lucky in the sense that what we do is fairly complex, and market dynamics generally will dictate that first movers with good operations and sort of the right intentions will retain, retain that sort of those eyeballs effectively. So we've been lucky in that sense. And, in our industry, it follows, again, similar market principles. In terms of, obstacles, generally, one of the major obstacles is going to be just the fact that this is an incredibly fast moving market. So, decentralized finance was sort of kicked off, let's say, early 2020 or so. And this is sort of out of the ashes of what we saw in 2017, 2018. And, it started from effectively zero and then peaked in terms of AUM. What was it, sort of like late 2021 at about 300 billion, which, when compared to traditional finance is fairly small, but there's been a huge uplift in both retail and institutional. So in terms of our obstacles, generally it's, retaining sort of eyeballs or interest in our product, because this space tends to be fleeting. We're lucky in the sense where we have a mix of retail and institutional, and they lever us for the varying things that we can offer, whether it's sort of long or short or market neutral positions. But again, because of this industry is so fast moving, that's almost the major obstacle, whereby, okay, we have a product today that works and is solid and people really like, but what's coming in the future, and where can we capture that value?
Yeah. So, I guess moving on past that, what are you most excited about, call it, in the near term? What really gets management excited in the next 6 months or so?
Yeah. So pertaining to DeFi, I mentioned Hover. So kind of taking a bite of that institutional market is really exciting for us. I'm personally excited. I've watched it grow the past year, where we mentioned sort of these smaller, like single seven figure funds that have grown really, really well over the past year. So they've gone from maybe, a couple mil AUM, and now they're at, 100, if not hundreds. And these are starting to kind of really, blow up. And it just means that the market is generally maturing a lot more. That could mean for some that yields will be, compressed. But, with sort of the maturing of the market, you're seeing a lot of organic, growth. And that's what our industry, fundamentally needs. Outside of that, we're going in, many different directions. We want to take a bite out of the gaming sector as well. So like the on-chain gaming, we had a venture we're building out, which will kind of tie into the game, which is the NFTs. Maybe not so suitable for this audience, but I think we're just excited on the success that we've had so far over the past year and change, and how we can kind of go forward and capture that. But for anyone looking at this from like a traditional finance side, I'm really excited to see what's the next entrance in. So we've seen these permission products sort of be announced, and just from word on the street is the people who are signing up to be on board into these permissioned DeFi products are much more traditional than you would expect. So seeing those actors trickle in, kind of getting comfortable, that's part of our job as well, is just to basically get people comfortable, understanding where the risk vectors are in this industry. But typically when people understand sort of where the risks can be and all the moving mechanics, then it's nothing outside of the scope of what they're used to in traditional markets, just in a different flavor.
Excellent. And we already have some very good Q&A rolling in from the audience, which I'll get to right after our call it prepared set of questions. If there's anyone out there that has a question, please feel free to email it to me. So, Pete, there's been a lot of investor conversation about regulation. What are your thoughts there about how that develops over time? And I guess what are your expectations?
Yeah. So with regulation, and I'll kind of wind this back. So I started off in fintech, and that was around 2012. Watched sort of fintech emerge when I was based out of London, and watched it basically globally to see how different regulators touch on this. The FCA typically let a sort of wait and see approach, weed out the bad actors, keep the good. Where the US kind of put a thumb on a lot that was going on until they had the appropriate framework and licenses that they could typically shape under the framework that we see today. This is an industry that will get regulated for sure. What that looks like, and I've been fairly impressed with the way the current administration has looked at crypto and DeFi. I think if you look back at 2017, 2018, when all of the ICOs were happening and a lot of the question marks around, what was the usefulness of sort of this new technology, there's a lot of people that were scared about, what would happen to their companies, even if they're doing things in the best sort of interest. And there were some kind of isolated cases of that happening. But I think the first touch point will be stable coins. So obviously USD denominated, which they're all denominated in USD. What that looks like. USDC clearly is sort of the chosen pony per se in the US, which makes complete sense from our perspective. And that'll be kind of the first touch point. And then, but they are taking a much more wait and see. We're talking about the US. A much more of a wait and see, and how can we understand this? Because I do think they do want to be competitive, and it has grown and shown kind of real use cases and ways that it increases or basically eliminates settlement times. You can move around capital very easily. It's a new sort of frontier of yield generating opportunities. So it definitely will get regulated. Stablecoins are likely the first. And then I do think, as much as regulators don't like to adapt or not adapt, sorry, create new laws around, new ecosystems and landscapes, I think that may have to be one, or ours have to be one, that there is something new that's brought out. So in 2018, you saw a lot of the firms that were going after like the security token digital asset space go after ATS licenses and money transmission licenses, which settlement layers do have. And that makes total sense. But in terms of our industry and how it's going to be regulated, there may be sort of a divergence between what is permissionless. And when I say permissionless, how typical DeFi protocols operate is all the capital is mixed in, so the lending capital is mixed in, and borrowers can borrow from that, which is problematic for some firms. I think we go to a permission model in the short-term future. And likely, I assume those will be regulated in some form or fashion. We have MiCA in EU that is going to put that kind of framework around all of DeFi. It's funny to see that Europe was a lot more free with regulation up to this point. And with MiCA, I think the US actually might be a better place to operate, which, anyone, I'm based in Canada, so we have, good exposure to the States, but you don't really get the understanding of the opportunity and scale unless you're in a place like, Bay Area, New York, or in some aspects, Miami.
Yeah, excellent. And, I think that this has been a really good use of time in providing a high level of understanding of the market. But now let's drill down more into Alpaca. So for investors that are not familiar with your company, would you mind providing just a brief overview of your business model and the key revenue drivers of your growth?
Sure. So we have a couple lines of business. Effectively, one side of the business has pools of capital that can be borrowed. Those pools of capital will yield based on the amount of capital in the pool against the utilization of that pool. And the utilization comes from people borrowing from those pools to lever up yield farming positions. So in that sense, we're under collateralized. So someone would come to us and say, I don't want to manage these like yield generating positions. I simply want to put in, say, a US denominated stablecoin and receive a variable yield. I'll sit there, and in our industry, we're permissionless, meaning anyone with if you heard about MetaMask or a Web3 wallet can interact with us. We're non-custodial, meaning there's no replication of funds. They sit into a smart contract, and that smart contract we developed to do a certain thing. So you can put the money in and pull the money out at any time. On the other side of the business, we have yield farming. So as you mentioned, with automated, so we have a DEX, so a decentralized exchange, so an exchange, and users and participants are providing liquidity to certain pairs inside that exchange. To provide that liquidity, you receive trading fees and different rewards, which accumulate to a base return. So we provide leverage on those positions, and in both cases, we charge a performance fee on both the lender and the borrower. We also have another product which is more of retail uses it, but more of a fund focused product, which a lot of funds we work with are market neutral funds. So they will either find two stablecoin pairs to participate with, or if there is a floating assets, they'll hedge out that exposure somewhere else, typically a centralized exchange. So what we did was we created this called an automated vault, which is an automated pseudo delta neutral position with higher leverage. In that product, we're typical kind of structure, let's say like a hedge fund where it's like a 2, in this case 2 and 15, but like a 2 and 20 type model. But on the core products, it's simply performance. And on this automated vault, we are managing a position. We're rebalancing through technology and providing like increased leverage. We effectively do like a 2 and 15 or like a hedge fund model for that product.
Excellent. In thinking about your investors, what type of investors are generally attracted to your platform? Is it more retail or institutions, and how do you see that evolving going forward?
So we have 30,000 users of our protocol. Let's use an 80-20 rule where 80% will be retail and then 20% institutions. So again, up to this point, as we're speaking, retail dominates DeFi, but that is slowly shifting, at least sort of like the percentage between. I mentioned before, like over the past year, we've seen these typically market neutral funds sort of scale up, and also new entrants kind of move into the market. So the crypto market makers tend to have a strong finance background, and they've done a carve out. I would say kind of started Q4 last year. They started doing carve outs of their core business to basically run a DeFi fund, and they spent 6 months prior using their own PA. So we'll call them retail, albeit their positions were much larger than retail, kind of understanding what we do, and then putting a risk framework and technology framework together. Obviously, we're not the only ones they deploy into, but they kind of use us, get comfortable with us, understanding kind of where the attack vectors are and whatnot, and then kind of scale up from there. So yeah, up to date, it's been predominantly retail. In terms of numbers, I don't, like in hard numbers of users, I don't see that changing, but in terms of AUM or people, deploying into our protocol, I think it won't drastically shift, talking 50-50, next year, but that'll slowly move the pendulum kind of in the way of institutions that are getting more comfortable in deploying into us and into DeFi.
Yeah, interesting. And I guess expanding on that, about how much is invested on your platform, and what type of returns are these people,
Sure. So right now we have about 650, 700 million deployed on our platform. Market for anyone at the moment isn't the greatest. So the value of assets and the amount of assets, for example, some people might just be sitting in cash, will change. But in high times, we've seen as high as about 1.4 billion. And on the lending pools, because the utilization will dictate the return, that floating return for people depositing the lending pools, that will vary. Institutional clients tend to sit in, let's say, USDT, USDC. Currently, that's ranging from about 3.5% to 5%, give or take. In high times, that's more like 7 to 11% APY. On the yield farming side, so leverage yield farming side, this ranges greatly. We're talking sort of 10% upwards, and I'm not going to scare anybody, but it goes much higher. But given that there is a higher risk, and there's also a lot more monitoring. Obviously, if you're borrowing capital, there's going to be a liquidation point against the collateral you have. So you have to manage that position, manage the market. So it's kind of like, call it risk-adjusted returns. On the automated vaults, which is the delta neutral strategy, we have two set of leverage: 3x leverage, which is around, call it 40%. And then the 8x is much higher. And that product, does need to be rebalanced, but we've back tested that a year, which includes a number of different drawdowns, akin to what we've seen, the last, month, or to be fair, if you want to argue, it's been sort of a downward sort of trend since December. That's all factored into the target yield. So obviously a lot higher than what you'll see in traditional finance, given the total value of the network is a lot less when compared to traditional finance. So again, risk-adjusted returns, the ones that have been in here since sort of 2017 onwards have done very well, but there's a lot of risks associated to this sort of this activity.
Of course, and you alluded to this in the answer to our last one. I guess, how has the recent downturn in crypto impacted your business? And in the event of a recovery to prior levels, I guess, how do you envision that?
Sure, it hasn't impacted us as a business as much as maybe others. So we offer, because you can borrow assets, you can effectively long or short or be neutral. And we've retained a good amount of capital through downturn. Some of the drops in, again, total value locked on our platform is kind of beholden to the value of these floating assets, which are on the platform. So that will affect sort of like the top line number and the value overall. But when compared to other DeFi protocols that may not have a strong revenue model in place, if any, and they're kind of solely working around what their like native token price looks like as a value of their protocol, then they've done a lot worse. I think whenever there's downturns in the market, people shift. So obviously in good times, it's sort of an up-only mentality. People are speculative on the native currency of all protocols. But when we see a market like this, which has typically been quite choppy and sort of crabbing sideways, or people kind of look at the macro and see there could be sort of downturn, which we saw sort of in December time, the whiffs of, then typically there's one or two things happens. Like most markets, they will liquidate to cash and wait for a better time to enter. Or if they're a yield generating fund, they'll kind of look to kind of hedge out their exposure. And typically that is sort of like the market neutral path. So we're quite well positioned, as I mentioned, that, for savvy investors and operators in the space, they can do a lot of different activities, whereby on other platforms you may not have those avenues. So that effectively moves over and goes elsewhere. But for us, we've held fairly strong.
Excellent. Thanks for the color. I'll relay some of our questions from the audience. So the first one has to deal with a rising rate environment. We know how to think about the impact of rising rates on traditional assets. How do you think about the impact of rising rates in crypto?
Yeah. So generally how the crypto market is structured, at least has been to date, is that, Bitcoin and Ethereum are sort of the leading indicators of the health of the market. And Bitcoin and Ethereum typically follow, at least at this point, traditional markets and the outlook. So when we had this huge run sort of through COVID times, because you could argue it was, low rate environment, there was, for retail, there was stimulus that was going around, and it was a buoyant market that I don't think many people expected. So, the Bitcoin is still seen as a risk-on asset, as is all of crypto, and the kind of speculative, either long or short nature, dwarfs what is happening, kind of yield generating activities in DeFi. So as markets kind of adjust to a higher rate environment, that could impact our market as well, and likely will. But I think we all look at it as there will be a time that we see a decoupling from, and that goes to the point of when more capital, more institutional eyeballs are comfortable and on this market, then there's likely sort of that decoupling opportunity where we kind of move away from macro. We can't solely move away from that, but we're kind of hoping that will happen in the future. So to the question, we're likely impacted. I don't think, as much as cycles from our side have greatly shortened, meaning in 2018, we had like a 2-year bear market because we're trying to find the utility and use case of DeFi. That's mostly been found on kind of a grassroots level. But, as much as this cycle is not going to be a 2-year market, we're still going to be impacted by the macro environment and traditional markets that will kind of, come into us.
Great. So our next question has to do with risks to your business model. What are the key risks, or the top 1 or 2?
So risks in our case, from a technical standpoint, so what we do on our side is someone's levering up a position. They're levering up that position with us, but that's going on a decentralized exchange. So there are a couple risks there. One on the technical front, meaning either they or we have an issue. So to date, we've had no loss of client capital and gone through many different audits. Obviously, audits aren't bulletproof, but they're a sign of us wanting to do the generally the right thing in the market. So that's one. These pools of capital, these pairs, have a reward distribution coming from the exchange and also us. So in the extent of, if the exchange decides to lessen or withdraw the rewards, that will kind of compress yields. So that's not a huge risk. It just possibly makes certain pools less attractive and other ones more attractive. I don't think regulation's quite a risk yet. There'll be adequate framework on how to work within different countries when that happens. But when we sort of quantify risk, we typically look at technical risks, and then, how sustainable are the yields? So we have many different pools and different pairs that we operate in. So we have to basically monitor and manage and look at, the yield against the cost to borrow to lever up those positions, and how that will impact sort of our users going forward. But I mentioned prior sort of, the the upgrades to infrastructure. And one of the things we're doing is sort of having like dynamic aspects of kind of the parameters around these pairs. So that's one of the ways we're kind of counteracting potential risk in the future.
Sure. Our next question from the audience is, can you speak about the actual yield farming mechanics? And I believe you actually may have addressed that, but perhaps just a super high level overview.
Yeah, so the high level overviews, you have a DEX, which is an automated market maker. You provide asset A, asset B in 50-50 ratio to the pool. You will have a share of that pool depending on how big that pool is, and then you'll receive the trading fees. So the centralized exchange will they'll set the baseline trading fee, could be 2 basis points or 20 basis points on trades that go on within that pool. And then on top of the trading fees, typically there's a native token, which is also given as a reward. So a set number of rewards are given to that one pair, and then you share in the rewards of that pair. With those tokens, you kind of liquidate, you can hold on to them, sort of up to you. But yeah, in very broad strokes, you are remunerated based on the amount of capital you provide against the capital in that pool, and then the trading fees and the rewards set for that pair. That will all equate into like a baseline return, which varies over time, right? So if more capital comes in, less you stand, or capital comes out of that pool, that will kind of vary. But those are kind of the broad stroke mechanics.
Excellent. And in terms of your retail or institutional clients, who's a better client for you? Which one is?
They're two different requirements. So the retail require different facilities than institutional. So our industry operates very transparently. So if you go on to our website, alpacafinance.org, and look at our docs, how we do business, how the mechanics work, it's very transparent. It's by no means a black box. So we often get a lot of questions around that from retail. It's generally kind of direction of company, what's a roadmap looking like, how are we on these type of products, and all of that centers around some community tools, which is Discord, which is one, and Telegram, which is another. So typically, the retail audience requires a lot of interaction from founding team members and community mods, which we do a lot of. I'm happy to do so. Where if we're talking institutional, they are typically, when they're getting ready to deploy, they want to understand sort of where the contracts are, what the models are of the underlying products, how they can query data and where that data is living, so they can move that into their risk framework. There's more of a technical support aspect institutional, because again, they'll have their offline risk framework for how they're investing, but typically also built their own technical kind of risk systems, which we have to plug in our data, and even sometimes to just build on top of our smart contracts and our pools. So we need to help them there. So it's very different. But yeah, it's very, very, very vastly different. So one isn't different than the other, just require different resources from our team.
Pete, I want to thank you so much for today. This has been tremendous. I think it's been a good use of time for our clients, and we're very excited to hear about Alpaca Finance. So thank you for joining us this afternoon.
Yeah, Brian, thanks for having me. I'm excited to see some feedback from listeners, and feel free to kind of reach out. I'm happy to talk about all the nuances in DeFi and how they equate to the traditional world.
Absolutely. It's always a pleasure speaking with you, and I look forward to chatting again soon.
Great. Thanks, Brian. Take care.